Welcome to the Pro Ticker Deep Dive.
It's great to be here.
It is Wednesday, February 4th, 2026. And I have to say, if you're listening to this on your commute, or maybe you're at the gym trying to sweat out the stress, and you haven't checked your portfolio yet today,
Oh boy.
maybe just don't. Just give it a few hours, or maybe a few days.
Or perhaps just wait until spring. Ignorance is bliss, right? At least for this morning.
It really is. It is essentially a sea of red ink out there.
Sea of red is putting it politely. I mean, it is just brutal.
It looks like a crime scene on the charts today, especially in the cryptocurrency sector. It feels like we are collectively nursing a massive pounding hangover.
That's a good way to put it.
You think back to late 2025, which is what, 3 or 4 months ago? And the vibe was completely different. It was electric.
Oh, complete euphoria.
Bitcoin was peaking around $126,000. The champagne was flowing. People were pricing out private islands. The sentiment was just off the charts. You couldn't go to a dinner party without someone telling you about their gains. And today...
And today, it's radio silence.
Yeah. Today, we're hovering in this painful, grinding, claustrophobic range between, $70,000, $80,000. It's just, ugh.
It is a brutal come down. The euphoria hasn't just faded, it has effectively evaporated. The psychology of the market has flipped 180 degrees in a remarkably short window of time.
And that pivot, that violent shift in sentiment, is the central mystery we are tackling today. How did we get here? How did the market go from an all-time high to flashing a death cross, which we will get into, and yes, it sounds as bad as it is in just a matter of weeks.
All right.
And the bigger question, the one that I think is haunting every investor right now as they stare at their screens, is this just a stumble? Is this a healthy, albeit painful, correction on the way to $200,000? Or is the fundamental 4-year cycle of crypto, the thing we've all relied on, actually broken?
That is the question of the year, isn't it? Is the cycle dead? And to answer that, we can't just look at a price chart that tells us what happened, but it doesn't really tell us why.
Right. It's the symptom, not the disease.
Exactly. We have to peel back the layers. We have to look at Washington, specifically the panic over the new Fed chair nomination and what that means for liquidity. We have to look at the corporate treasuries, the companies like Strategy Inc., which, used to be MicroStrategy, because they are facing a structural stress test that could implode their stock price.
And the plumbing of the market itself.
And the plumbing of the market, the ETFs, and the new regulatory landscape that's forming under the Clarity Act. It's a lot to untack.
It's a complex web. So here's our roadmap for this deep dive. We're going to start with the anatomy of the crash itself, specifically this death cross and why the algorithms are reacting to it.
Yep.
Then we're going to pivot to the macro triggers, the Kevin Warsh nomination, and why the bond market is freaking out. After that, a deep dive into the crisis at Strategy Inc., because that situation is fascinating and, frankly, a little terrifying if you hold the stock.
It's a cautionary tale.
It really is. Then we've got our buy and sell signals for the week, Alphabet versus Strategy, and we'll wrap up with the legal framework that's shifting under our feet.
It's a perfect storm. You have macro fear, technical breakdowns, and structural leverage issues all hitting at the exact same moment.
A perfect storm is the right phrase. So let's start with the damage report. Section 1, the crash. I mentioned the $126,000 peak. We are down roughly 40% from there. That is a bear market by any traditional definition, isn't it?
Oh, absolutely. In the equities world, a 20% drop is a bear market. In crypto, we usually have thicker skin, but 40% is significant. It's a real drawdown.
It stings no matter how you slice it.
It does. And what's concerning to me isn't just the percentage drop. Crypto is volatile. We know that. 40% drops happen. What's concerning is the behavior of the price action right now. We are seeing this tight price compression between the low $80 and the mid $90,000. But recently, we keep testing the floor.
Right. Those dips down to the mid-70s.
We've had dips testing as low as $74,500, and that's where you have to get a little nervous.
And usually in technical analysis, people think, oh, it bounced off the floor. That means the floor is strong. That's the intuition, right? If you hit a wall and don't go through it, the wall is sturdy.
That's a common misconception, but in markets, it's often the opposite. I like to think of it like a frozen lake. You can jump on the ice once, and it holds.
Okay.
You jump on it twice, it holds. But if you keep jumping on the same spot over and over and over again, eventually that ice creates a fissure. It fatigues.
It gets weaker, not stronger.
Exactly.
Yeah.
When you test the bottom of a range that many times, the floor doesn't get stronger. It gets creaky, gets weak, because the buyers who are defending that level, well, they run out of ammo.
And when that flare breaks, the fall isn't a gentle slide, it's a cliff. We saw a massive liquidation event just recently that proves how fragile this is.
We did. One recent drop wiped out about $319.25 million in positions in a very, very short window. And we need to be clear about who is getting hurt here.
Right. This isn't just regular selling.
This isn't people selling because they want to buy a house. This is mostly long positions. People betting the price would go up, getting flushed out, completely liquidated.
Can we explain the mechanics of that for a second? When we say liquidation, we aren't just talking about someone selling because they're scared. This is forced selling, right? This is the repo man coming for your trades.
That's a perfect analogy, exactly. This is all about leverage. Traders are borrowing money from exchanges to bet on Bitcoin. So let's say you put down $1,000 to bet on $10,000 worth of Bitcoin. That's 10x leverage.
Okay.
If the price drops just 10%, your $1,000 is gone. The exchange says your collateral isn't enough to cover the loan anymore, and the exchange's computer automatically sells your Bitcoin to get their money back.
They don't call you and ask nicely.
They don't wait for the market to bounce, they just sell instantly. It's a hard automated process.
And that selling drives the price down further, which then hits the next guy's liquidation price.
Which triggers the next guy's liquidation point. It creates a cascade, a vicious feedback loop. The price drops, triggers stop losses and liquidations, which creates more selling, which drops the price further. That is what happened to wipe out that $319 million. It washes out the weak hands, but it also inflicts a lot of pain on the price structure.
Right in the middle of this mess, on February 2nd, a specific technical indicator flashed. The death cross.
The dreaded death cross.
Now, I know technical analysis can sometimes feel like reading tea leaves or horoscopes to the uninitiated, but this one seems to carry a lot of weight with the big institutional desks. What exactly happened on the charts?
It's a classic signal, and you're right to be skeptical of some technicals, but whether you believe in it or not, the algorithms that manage billions of dollars do believe in it.
So it becomes a self-fulfilling prophecy.
It absolutely does. A death cross happens when a short-term moving average crosses below a long-term moving average. Specifically, in this instance, the 50-day moving average crossed below the 200-day moving average.
Okay, so let's translate that into plain English. The 50-day average is the short-term trend. How have we been doing for the last month and a half or so?
Right, your recent momentum.
And the 200-day is the long-term trend. How have we been doing for the last, 6, 7 months?
Roughly, yeah. Almost a year. So when the short term falls below the long term, it mathematically signifies a major loss of momentum. It tells you that the recent price action is significantly worse than the longer historical trend. The trend has shifted from bullish, where recent prices are higher, to bearish, where recent prices are dragging everything down.
Why is this specific cross called the death cross? It sounds incredibly dramatic, like something out of a heavy metal album.
It is dramatic because of what it implies about time. See, historically, a death cross signals prolonged periods of underperformance. It's not a signal that says, hey, we will drop 10% tomorrow.
It's not an immediate crash indicator.
No, it's a signal that says, we are entering a winter. The market needs time to repair that technical damage. The buyers are exhausted, and the sellers are in control. It often marks the transition from a buy the dip mentality to a sell the rally mentality.
So for the listener hoping for a V-shaped recovery where we crash and then immediately rocket back up to $100,000 by next Tuesday, this signal suggests that is off the table.
It makes it highly, highly unlikely. It suggests the bears are in control for the foreseeable future. We are looking at a grind, not a bounce. We need to build a base, and that takes time. A lot of time.
Okay, so if the bears are in control, the next logical question is, how low can this go? I've seen analysts throwing around some numbers that, quite frankly, made my stomach turn.
Yeah, the downside targets are not pretty. There are a few levels we need to watch very closely. In the short term, we're looking at this consolidation band between, say, $82,000 and $85,000. If we can hold that, we might stabilize for a bit.
But if that $74,500 floor breaks,
If that floor breaks, and remember, that was the low from April 2025, and markets have a memory for these numbers, the next major stop is significantly lower. We are looking at $68,000.
$68,000. Why that specific number? What's the significance there?
That aligns with the 200-week exponential moving average. In the world of crypto technical analysis, the 200-week moving average is often considered the ultimate line in the sand.
The last line of defense.
It really is. It's the baseline for the secular bull market. If you stay above it, the long-term story is intact. It's just a correction. If you lose $68,000, The narrative changes. It means the secular trend might be broken.
And if we lose $68,000, what's below that?
Then you have to start looking at the extreme bearish scenarios. Some respected analysts are pointing to a potential drop to $53,000.
$53,000. That is
Yeah.
that is a long way down from $126,000.
It is.
That's more than a 50% haircut from the top. That's getting into real crypto winter territory.
It is. That $53,000 figure comes from a 100% Fibonacci extension from the previous move.
Explain Fibonacci extension for us quickly. It sounds like something from the Da Vinci Code.
It does, doesn't it? It's based on the idea that markets move in mathematical ratios based on human psychology. Traders look at a previous move, say a drop and a bounce, and project how far the next drop will go based on these golden ratios found in nature.
So it's pattern recognition.
Exactly. And 100% extension basically means the next leg down will be equal in magnitude to the first leg down. It's a worst-case scenario, but in this environment, with this negative momentum, you cannot rule it out. You just can't.
Okay, so the charts look terrible. The technicals are screaming, caution. But charts are usually just a reflection of what is happening in the real world. They are the symptom, not the disease. What triggered this specific bout of volatility? Because it feels like something snapped this past weekend.
It did snap, and the call was coming from inside the House, specifically the White House, or rather the speculation about the White House. The immediate trigger was the rumor mill surrounding the Trump administration's nominee for Federal Reserve Chair.
This is the Kevin Warsh factor.
Precisely. Kevin Warsh. Reports started circulating that he is the likely nominee to replace the current chair, and the market. Well, the market did not take that well at all.
Which is interesting, because I thought Wall Street generally liked Warsh. He's a former Fed governor, he's a known entity, he's well-spoken. Why is his nomination causing a crypto crash?
He is a known entity, but he is known for a specific thing. Warsh is historically viewed as a hawk.
A hawk, meaning he hates inflation more than he likes stock market rallies. He wants to keep money tight.
Correct. A dove wants to keep interest rates low to stimulate jobs and growth. A hawk wants to keep rates high and money tight to crush inflation and protect the dollar. And Warsh, especially during his time at the Fed from 2006 to 2011, was very, very vocal about the dangers of easy money.
So he's not a fan of the money printer.
He favors a smaller Fed balance sheet. He was skeptical of QE, quantitative easing, which is basically the fuel that crypto runs on.
Even though he has been using some more dovish language recently, I've heard him talk about needing to support growth and align with the administration.
He has, and that's likely because he wants to align himself with the administration's desire for a strong economy. It's a job interview, after all. But markets have long memories.
They look at the track record, not the talk.
They look at his track record, not just his recent sound bites. And his track record suggests he prefers tighter policy. But the bigger issue here isn't just his policy, it's the uncertainty. This introduced what we call a binary event risk.
Binary event risk, meaning it's a coin flip. It's all or nothing.
Exactly. Suddenly, traders aren't sure, is the guy in charge of the money printer going to keep it running, or is he going to unplug it? And crypto assets are famously, almost uniquely, sensitive to liquidity. They need cheap money to thrive. If Warsh turns off the spigot, the party is over.
It's the uncertainty principle. If you don't know if the rules of the game are about to change, you take your chips off the table. You sell your risky assets first.
You sell first and ask questions later. Markets hate bad news, but they hate uncertainty even more. You can price in bad news, you can't price in maybe.
And the current Fed, the one still in power today, isn't helping matters either. The FOMC just met and left rates on hold at 3.75%.
Which was expected. Nobody thought they would cut this week.
Right, but the hope was for a signal.
True, but the market was hoping for a signal that a cut was coming in March. They wanted a wink and a nod. Instead, we got data that makes a cut almost impossible. Unemployment claims were slightly high at 209,000, which is bad for the economy. But the real kicker was the PPI, the Producer Price Index.
That's the inflation number for the wholesale level, right? What factories pay.
Right. It measures how much factories and producers are paying for goods. It came in at 0.7%, which was significantly hotter than expected.
Why should the average listener care about the Producer Price Index? It seems kind of obscure.
Because if the factory pays more for steel or lumber or microchips today, you pay more for the car or the house or the phone tomorrow. It's a direct pass-through. High PPI is a leading indicator for high CPI consumer inflation.
So it means inflation isn't dead.
It means inflation isn't dead. It's zombie walking back to life.
And hotter inflation means the Fed is stuck. They can't cut rates if prices are rising. Their hands are tied.
They are handcuffed. The likelihood of a March rate cut based on the futures market has absolutely plummeted. It's down to just 8.9%, basically zero.
Wow.
So the market was clinging to this hope. Okay, the economy is slowing, but the Fed will save us with a rate cut. That hope is gone. The cavalry isn't coming.
And just to add a cherry on top of this misery Sunday, we have another government shutdown looming.
We do. It's become almost routine in American politics, hasn't it? But we shouldn't underestimate it. A shutdown acts as a stress test on the market's psyche.
It's not a direct economic shock, but it's the sentiment killer.
It is a massive sentiment killer. It just creates noise and fear. It keeps traders cautious. It pushes them towards smaller position sizes. So you combine a hawkish Fed nominee like Warsh, hot inflation data preventing a rate cut, and a government shutdown. The risk appetite just disappears.
Nobody wants to be a hero.
Nobody wants to be the hero buying the dip with huge leverage when the government might close its doors on Friday.
It feels like the safety net has been pulled away. And speaking of safety nets, I want to talk about this identity crisis Bitcoin is having. For a long time, certainly for the last 5 years, the sales pitch was very specific.
Oh yeah, we all know the pitch.
Bitcoin is digital gold. It is a safe haven. It is uncorrelated. When stocks crash, when the world goes crazy, Bitcoin holds value.
That was the narrative. That was the slide in every pitch deck. That was why you allocated 5% of your portfolio to it. It was your disaster insurance.
But that is demonstrably not what is happening right now, is it?
Not at all. In fact, Robbie Mitchnick, who's BlackRock's head of digital asset strategy, recently said Bitcoin is confusing right now because it acts like digital gold one day and a risk asset the next. But if you actually look at the data, the hard math, the confusion clears up pretty quickly.
It's acting like a risk asset.
It is behaving like a risk asset. Period. End of story.
The correlation numbers are actually wild when you compare them to a few years ago.
They are. Let's look at the change. Back in 2021, Bitcoin's correlation to equities, to the S&P 500 or NASDAQ, was about 0.15.
0.15. That's basically zero. That means they moved independently. One zigs, the other zags.
They had almost no relationship. One could go up, the other down, no problem. Today, in January 2026, that correlation is 0.75.
0.75. So they're practically moving in lockstep. They're tied at the hip.
They are dancing the same dance. But here is the statistic that really shocked me, and this is a new development. Bitcoin's volatility now correlates 0.88 with the VIX.
Okay, let's unpack that. The VIX is the fear gauge for the stock market. It measures how much traders expect the S&P 500 to jump around.
Right. So when stock market fear goes up, Bitcoin volatility goes up. This 0.88 correlation is the highest level ever recorded. Ever.
So what does that tell us about who is trading Bitcoin? This isn't the retail guy anymore.
It tells us that the crypto natives, the idealists, the libertarians who believe in separating money from state, they aren't setting the price anymore. Institutions are running the show. This correlation proves that big institutional algorithms are treating Bitcoin exactly like a high beta tech stock.
High beta meaning it's just a magnified version of the stock market.
Exactly. If the NASDAQ goes down 1%, Bitcoin goes down 3%. When the risk parity funds, these massive algorithmic models, decide to sell volatility or de-risk, they sell Bitcoin alongside NVIDIA, alongside Tesla, alongside their junk bonds.
So it's just another line item in their risk model.
It is no longer acting as a diversification hedge. If your stocks are crashing, your Bitcoin is crashing too, maybe even harder.
That defeats the whole purpose of holding it as a hedge. If I buy insurance against my house burning down, I don't want the insurance policy to lose value exactly when the fire starts.
Precisely. That is the narrative violation we are seeing. But for the institutions, it has become a liquidity vehicle. It trades 2047. It's easy to sell. When they need cash to cover margin calls elsewhere, they sell what is liquid. And we are seeing this in the ETF flows.
The outflows have been heavy.
Heavy is an understatement. We saw $1.137 billion in net withdrawals over just 5 trading days, from January 20th to the 26th, over $1 billion.
And just to be clear, this isn't mom and pop selling $50 worth of Bitcoin on an app because they need to pay rent.
No, this is big money. 92% of those outflows came from just 3 major products: Fidelity, ARK, and Grayscale. These are vehicles used by financial advisors, wealth managers, and hedge funds.
So this is sophisticated money.
This is sophisticated money. These are allocators who manage billions, and they're systematically de-risking. They are moving out of digital assets and into cash or precious metals.
So the smart money is leaving the room. That's a very concerning signal.
It signals a complete lack of confidence in the short-term asset class. They are looking at the macro picture, the Fed, the Warsh nomination, and deciding to sit on the sidelines. They are hodling like the faithful. They are trading. And right now, the trade is sell.
Well, if the institutions are selling, that puts massive pressure on the companies that have tied their entire existence to Bitcoin. We have to talk about the datecos, the digital asset treasury companies,
Yes.
and specifically the elephant in the room,
Yeah.
Strategy Inc., formerly known as MicroStrategy.
This is where the structural damage becomes really apparent. Strategy Inc. essentially pioneered this model of a public company acting as a Bitcoin vault. They turned a software company into a Bitcoin accumulation machine.
And they hold a massive amount of Bitcoin, an insane amount.
Approximately 712,647 Bitcoin. It is an astronomical hoard. For context, that is roughly 3.4% of all Bitcoin that will ever exist in one company.
But the stock is in trouble.
Yeah.
Big trouble.
It is. The stock is currently trading at a discount to its net asset value, or NAV.
Okay, I want to spend a minute here because this is crucial. Explain this for the listener who might not be a Wall Street pro. Why is trading at a discount such a big deal for them? It sounds like you're getting a bargain.
Right. It sounds good, but for them, it's a disaster. So previously, Strategy Inc. traded at a massive premium. Let's say they held $1 billion worth of Bitcoin. The stock market might value the company at $2 billion.
Why would anyone pay $2 for $1 worth of Bitcoin? That seems irrational.
It does, but there was a logic to it. Investors wanted exposure to Bitcoin and couldn't buy it easily. Or they were betting on Michael Saylor's ability to borrow money cheaply to buy more Bitcoin. It was what some people called the infinite money glitch.
Right. Since the stock was expensive, trading at a premium, they could issue new shares, get a ton of cash from the market, and use that cash to buy more Bitcoin.
Exactly. They issue overvalued stock to buy the underlying asset. This increased the amount of Bitcoin per share. It was a positive feedback loop, a beautiful one for them. High stock price leads to selling stock, which leads to buying Bitcoin, which pushes the Bitcoin price up, which pushes the stock price up even more. It was alchemy.
But now you said it's trading at a discount.
The loop has reversed. The stock is trading at roughly a 0.7 times its Bitcoin holdings.
So if they have $100 of Bitcoin on their balance sheet, the market is saying the company's only worth $70.
Roughly, yes. And that breaks the infinite money glitch. It shatters it. If you trade at a discount, you cannot issue new shares to buy Bitcoin.
Because you'd be getting ripped off.
If you did, you'd be selling $70 worth of stock to buy $100 worth of Bitcoin. You'd be diluting your existing shareholders. You're destroying value. You are essentially setting money on fire. The model is broken.
So the machine is jammed.
The machine is jammed. The reflexive loop where high stock price led to more buying has snapped back. Now, the lower the stock goes, the wider the discount might get. One analyst called the model an abomination, now that it's broken.
Wow.
And on top of that, the company is effectively underwater on its recent holdings. Their average cost basis is around $76,000. With Bitcoin dipping below that, they are sitting on massive, unrealized losses.
There's a ticking time bomb with the index, right? The MSCI.
The MSCI index risk. This is a massive structural threat that I don't think a lot of people are watching. Strategy Inc. is included in the MSCI World Index, which means thousands of passive index funds have to own it. It's just part of the basket.
There are rules for staying in the index.
There are rules. If the market cap drops too low or if the liquidity dries up, they can be excluded, kicked out of the club.
What happens if they get kicked out?
If they get excluded, all those passive funds, the robots that blindly buy the index, have to sell the stock instantly. They don't have a choice. It's in their mandate. It is estimated this could trigger $8.8 billion in forced sales.
$8.8 billion. That would be catastrophic for the stock price.
It would crush the stock, which would widen the discount to NAV, which makes the situation even worse. It's a death spiral scenario. It's a very, very dangerous spot for them to be in.
And they aren't the only ones doing this.
No, not at all. You look at MRA Holdings, 21
Yeah.
Capital, look at Metaplanet in Japan. They copied the Strategy Inc. playbook, but they did it at the top.
Oh, no.
They are deeply underwater. Their average buy price is $102,000.
Ouch. Buying at the absolute top. That's just painful.
Experts are predicting massive consolidation. I mean, many of these Bitcoin treasury companies simply will not survive 2026 if this price action continues. The model works great in a bull market. It acts like leverage, but it is absolutely brutal in a bear market.
So given all this doom and gloom broken models, crashing prices, hawkish Feds, let's look at the week ahead. We have some buy and sell recommendations coming from the analysts.
Yeah.
And honestly, it's not surprising given what we just discussed. Strategy Inc. is on the chopping block.
It is. The recommendation for the week is a hard sell on Strategy Inc. No surprise there.
Walk us through the rationale. Is it just the NAV issue or is there more to it?
It's the NAV issue, but it's also earnings. They are reporting earnings this week under very different circumstances than before. There's no good news to report. They have staggering unrealized losses. Remember, they reported a $17.44 billion loss in Q3 2025 due to crypto declines.
And Q4 was a bloodbath.
Q4 isn't going to look pretty, and the volatility risk is just too high.
The beta, right.
The technical beta is 3.4. That means if the broader market drops 1%, strategy historically drops 3.4%. In a risk-off environment where everyone is scared of the Fed, you do not want to be holding an asset that falls 3 times faster than the market. It's like holding a stick of dynamite while running through a fire.
Okay, so strategy is a sell. What is the buy? Where are people hiding? Where's the money flowing to?
The buy recommendation is Alphabet, the parent company of Google.
A pivot back to big tech. A flight to quality.
It's a classic flight to quality. Alphabet is heading into earnings with high expectations. Their ad business is showing renewed strength. Companies are spending money on ads again, which is a good economic sign. And the AI contributions from Search, YouTube, Google Cloud are finally accelerating in a way that shows up on the bottom line.
So investors are saying, I want growth, but I want proven, profitable growth. I don't want magic internet money growth.
Exactly. They want cash flow. They want a moat. They want a business that works regardless of what the Fed does. The trade setup suggests entering around $338 to $340, targeting a move up to $355. It's a 5% gain.
Which is not a to-the-moon crypto gain.
No, but in this market, say 5% is gold. It's about capital preservation right now.
It really highlights that shift we talked about earlier, money leaving speculative assets and moving toward established cash flow machines.
It's the classic risk-off rotation, sell the dream, buy the reality.
Now, I want to zoom out a bit. We've talked about the crash, the companies, the Fed, but there is a legal framework being built in the background that could change everything. Let's talk about the regulatory landscape for 2026, specifically H.R. 3633, the Clarity Act.
The Digital Asset Market Clarity Act of 2025. This is a huge piece of legislation that has flown a bit under the radar because everyone's been focused on the price crash.
What does it actually do? Because usually clarity in Washington just means more paperwork.
Well, there will be more paperwork, but in this case, it actually tries to solve the biggest headache in crypto. Who regulates what? For years, we've had this turf war. Is crypto a commodity like wheat or gold? Or is it a security like a stock?
The SEC says everything's a stock. The CFTC says it's a commodity, and the companies are stuck in the middle getting sued by everybody.
Right. This act creates a clear distinction. It sets up a framework where if a blockchain is mature and decentralized enough, meaning no single person or entity controls it, the asset is a digital commodity and is regulated by the CFTC.
Which is generally seen as the friendlier regulator for this space.
Generally, yes. The CFTC is used to dealing with commodities markets, derivatives, hedging. They aren't trying to regulate software code as if it were a corporate board. And if it's not decentralized, then it's a security regulated by the SEC. Simple as that.
Where is this bill right now? Is it going to become law?
It passed the House, and it's currently in the Senate Committee on Banking. It's moving. It's not law yet, but it's the closest we've gotten to a real rule book in the U.S.
How does this compare to the rest of the world? Because for a while, the U.S. was lagging behind.
Europe is definitely ahead. The MiCA framework markets in crypto assets is fully applicable now, and we are seeing the effects. Europe is seeing a rotation toward MiCA-compliant stablecoins. The market there is cleaner, more regulated.
So institutional investors feel safer there.
They feel much safer there. The U.S. is playing catch-up, but aggressively. We also have the Genius Act for stablecoins, which is creating an international benchmark. And in Asia, Japan, and Singapore are implementing really strict custodial rules. The whole world is professionalizing.
It seems like 2026 is the year of the stablecoin. That's where the regulatory focus is.
It really is. I think governments have realized they probably can't ban crypto entirely. It's too distributed. But they can control the on-ramps and off-ramps. And the biggest ramp is the stablecoin. If you control the stablecoins, you control the flows for anti-money laundering and financial stability. That's the choke point.
So we have regulation coming, which is good long-term but adds friction now. We have a market crash. We have institutional panic. This brings us to the future outlook. Is the cycle broken? We all know the 4-year cycle. The idea that Bitcoin follows the halving schedule like clockwork. Halving happens, supply gets cut, price goes up.
That is the great debate right now. The bear case is that the death cross and this high correlation with stocks prove that the old rules don't apply anymore. They're obsolete.
Because Wall Street algorithms don't care about the halving. They don't have a little calendar marked.
Exactly. They care about liquidity, interest rates, and earnings. If Wall Street owns the float, Wall Street sets the price. The halving is a supply shock, sure. But basic economics says prices, supply, and demand. If demand collapses because the Fed is hawkish, it doesn't matter if supply gets cut. The price will drop.
That's a pretty depressing thought for the crypto purists who believe the code is law. Is there a bull case? Is there any light at the end of the tunnel?
There is. Some analysts argue this is just a consolidation, a painful, drawn-out one before a commodity-style catch-up. They believe that once the macro dust settles, once we know who the Fed chair is, once the inflation spikes settle, the fundamental scarcity of Bitcoin will assert itself again.
Are people still predicting big numbers? Or has everyone given up and gone home?
Surprisingly, some analysts still see a path to $150,000 in 2026.
$150,000. We're at $75,000. That's a double from here in this market.
It is. It seems crazy right now. But they argue it will be driven by global liquidity changes. Eventually, the Fed will have to cut. Eventually, the money printer will turn back on. It's the history of fiat currency. And when it does, Bitcoin acts as that high beta sponge for liquidity. It could fly.
But the immediate road is very, very rocky.
Very rocky. It depends entirely on the Fed's next move and whether those institutional outflows stop. If the ETFs keep bleeding $1 billion a week, we aren't going to $150,000. We're going to $50,000. It's that simple.
What about the structural changes in the derivatives market, the options? Is there anything interesting there?
That's actually a glimmer of hope. We saw a massive reset in options open interest. About 45% of positions were cleared out in the recent crash.
So the system has been flushed? The leverage is gone.
Cleared the decks is the phrase people are using. The market is lighter, it's healthier, and implied volatility may have bottomed. That suggests that big moves are coming.
Okay, but in which direction?
That's the thing. It could be big moves down, but typically when volatility bottoms like this after a flush, you get a breakout. The spring is coiled.
So we are sitting on a powder keg. It could blow up or it could blow down.
Precisely. The market is coiled for a big move.
Okay, let's wrap this up. Recap the perfect storm for us. If I'm explaining this to my friends at dinner tonight, what are the 3 things I need to say?
It's 3 pillars. 1, macro fear. The nomination of Kevin Warsh and a hawkish Fed outlook is scaring away the money. 2, technical breakdown. The death cross signals a long winter, and we're losing key support levels. And 3, structural failure. The Bitcoin treasury model used by companies like Strategy Inc. is broken and under immense pressure to unwind.
It's a transition point.
It's a huge transition point. The market is transitioning from defensive deleveraging, which is just panic selling, to selective re-risking. But the key takeaway is that the safety net is gone. You can't just buy blindly and expect to get rich anymore. The easy mode is over.
Here's my final thought, and it's something I want the listeners to really chew on. If Bitcoin is now mathematically correlated to the stock market, if it moves with the VIX, if it moves with the NASDAQ, and if it is controlled by institutional risk models, has it lost its soul? Has it lost its original purpose as a hedge against the system?
That is the existential question, isn't it? If it's just another tech stock, why not just buy NVIDIA? At least it pays a dividend.
Exactly. And if Strategy Inc. can't print money to buy Bitcoin anymore, who is left to buy the dip?
That is the question that will determine the price in 2026.
On that cheery note, stay sharp out there, everyone. It's going to be a volatile week. Keep your eyes on the charts, keep your eyes on the Fed, and maybe keep a bottle of antacid handy. Thanks for listening to the Pro Ticker Deep Dive. We'll see you next time.